Okay. Does everybody who wants to be here is here? I know that. Well, I thought I'd find out if you could answer it. You want to be here? How about you two? Sit down. Unless you want to speak, if you two want to speak, you can be up front here. Otherwise, I'm ready to rock and roll. That's all right. I know how that works. Good morning. I'm Todd Grill. I'm happy to be here. I'm going to talk about self-directed IRAs, but before I do, because I have the stump here, I always have to get a few issues off my chest before I start. They're always little hot buttons for me. But before I do, my background is in real estate investing. I got into self-directed IRAs because I was given lots of misinformation about how it works. Told it was very expensive, cumbersome. And I couldn't find a company in the upper Midwest to facilitate my investments. So that's actually how I got into it. It was a fluke. It was by the grace of God, I just seized an opportunity and started this company. So that's kind of what happened. So I am one of you. I can relate to all the issues that you have. Most of them piss me off. Real estate has created my wealth, but it is, it's a pain in the butt. There's no question about it, because you've got to be actively involved in it. And everybody thinks they understand real estate and they're a real estate investor. Of course, that's an issue I have too, because most of them don't understand real estate. I don't have a PowerPoint. My PowerPoint's about 2 hours to 3 hours long. But if any of you want a copy of my PowerPoint, we'll email it to you. So all you need to do is, at our booth, drop off a card or write down your email address, and I'll email you the PowerPoint, and you'll have the whole amount of it, because I've got 45 minutes to just talk about concepts. So if you want to do that, happy to do that for you. In one of the recent magazines I read, it's called CRS, Certified Residential Specialist Magazine. They were talking about closing costs, and they were listing the 5 highest closing cost states and the 5 lowest closing cost states. So, anybody have a guess where Iowa falls in on closing costs, high or low? Low. Oh, who said low? Okay, and out of the top 5, what number do you think they're in?
Probably number 3.
Pretty darn good. They're number 4. And just for that, I'm going to give you a workbook, if you stick around. Okay, yeah, the highest closing costs are New York, Texas, Pennsylvania, Florida, and Oklahoma. Now, I wouldn't have known that. I would have guessed about Oklahoma. I would have guessed about New York. Anything out east, obviously, they typically have attorneys closing these, and that's why the closing costs are so high. But the states with the lowest closing costs are Missouri is number 1, Kansas was number 2, Colorado was number 3, Iowa was number 4, and Arkansas was number 5. Now, Minnesota's not in there. Minnesota's probably, where I come from, is in about the middle of the pack. Just came back from the National Association of Realtors convention. This year, it was down in Orlando, which is typically not a huge draw. Vegas and Orleans are a big draw. Usually at those meetings, they probably get 18,000 to 20,000 realtors that come there. I am not a realtor anymore, but I go to these meetings because I like to learn. This meeting was down because none of the realtors from the Northeast came, because their property was flooded or burned or they had a problem. So they had huge amounts of cancellations from the realtors in the Northeast quadrant of the United States. Some of the realtors that I have known, I was on the board of directors for the National Association of Realtors 3 times. So I have a number of friends still at the National Association. And yeah, the stories are pretty devastating, no question about it. They have these big exhibits. That's one of the reasons I like going there, is to see what is new. And it's been a few years since I've been to the National Association of Realtors convention, and there wasn't anything new that wowed me, which is very disappointing for the real estate industry. And here's what was the most disappointing to me. The realtor industry, and I love realtors because I love salespeople, and I think realtors help move that real estate industry forward. But here's the problem. They are a very archaic group, and they're run by people my age and older. That's the problem. There was not one company in the exhibits, and there was over 1,100 exhibits, not one company that was promoting mobile apps. So let me keep going. I don't know how, and don't think I pick on realtors because I was one. Here's what the Realtors Association, I'm going to get off my issue pretty quick. Here's what the problem is, the realtor industry. The multiple listing service is a dead issue. It is going to be a dead animal. And these associations are hanging on to the multiple listing service because you as a realtor want the multiple listing and access to all the listings, and because of that, and the associations own these, you have to pay dues to the local association, the state association, and the national association. You're locked into that trifecta. And these associations won't give up the multiple listing. Well, this is what they don't know, because I'm past president of 2 states in the association. The multiple listing is dead. It's all going to be mobile apps nationwide, and they won't give that up. That's what the consumer's looking for. And for you older investors, if you don't grab onto these mobile apps and understand this, you're going to be lost. You just will be. Okay, that takes care of that issue. A little better. Here's one that really pisses me off. These banks. I don't know if you're aware, because I hate banks. If you could all be bankers, and I'd tell you I hate you. When they funded TARP, and in that TARP policy, when they designated $4 to $5 billion to these small banks, in the policy, they weren't required. Part of the reason that they funded it within TARP, that $4 to $5 billion, and it was designated to small banks. That was supposed to be used totally for small business funding, in addition to the SBA, separate from SBA. But in the TARP Act, it was the money was designated for small business lending. It wasn't required. Now, how could our representatives have screwed that up? So do you know what these banks did? Out of the $4 to $5 billion that they were given, over half of that money these small banks used to pay down the debt at the bank so they could get the FDIC off their back. Here's the problem. Yeah, none of you have been screaming at your congresspeople and representatives about it because they bury this crap and no one knows it. That's why none of us can get business loans. Oh, yeah. That's another issue. I don't know how to solve it. I just like complaining. Okay, I got that one off. Okay, here's another one that's coming up. I'll get through here pretty quick. Starting January 1st, I'm sure you're probably aware of the 3.8% tax that's going to be implemented on all investments. And if you don't understand this and are not aware of this, you better call your CPA today and find out how that 3.8% Medicare tax is going to be affecting all of your investments, depending on your income level. Now here's the good part. It doesn't affect an investment in a traditional or Roth IRA. That's pretty cool. If you're buying investments privately and selling them, you're going to pay 3.8% tax depending on your income tax bracket. If you do it in a retirement plan, you're not going to pay that. Why don't you call your CPA and find out how smart they are and have them understand and explain to you what the potential of this tax might be for you. Just put it on your radar. please. Another one, this is kind of a fun one. Crowdfunding, the Jobs Act. How many of you are aware of the Jobs Act that was passed April 5th of this year? In the Jobs Act that was passed by Obama, that's one of the reasons I do like him. It's not, I don't like all of his stuff, but the Jobs Act was passed in April 5th of this year. And what's really cool is starting next year, because of the Jobs Act, and that's going through the SEC right now, it's going to allow any company after the first of the year who wants to raise capital of $1 million or less to not have to file with the SEC. Right now, any business that wants to raise capital and is going out to the public, they have to file with the SEC. And the SEC filings cost $50,000 to $100,000. That's how these darn attorneys make so much money on these SEC filings. Well, after the first of the year, any business that wants to raise $1 million or less can do what they call social networking and raise capital from individuals that they do not know, and they don't have to file that with the SEC. It's called crowdfunding. If you are owner of a business or you know people who own businesses like this, you need to be aware of this. This is something that I'm focusing on right now. I've been going to these seminars on crowdfunding. I'm going to become an expert in it because I think it is going to be the biggest thing that is hit. I thought I was turned on about self-directed IRAs. No, this crowdfunding thing is a huge deal. And again, let's just see if your advisor, CPA, attorney, anybody understands crowdfunding. If you don't, go to crowdfunding.org, and then you'll learn about crowdfunding. It's going to be really cool. Okay. That took care of some of them. So let's talk about, I want to make this open. So I do better when, because I'm not doing a PowerPoint. I really like it when I get questions, although I get sidetracked, but I do like the questions. So if you're brave enough to ask a question, please do so. One of the provisions in the rules that were passed in 2010 is that anyone, regardless of income, can convert their traditional IRA to a Roth. Before 2010, you had to make $100,000 or less in order to convert your traditional IRA to a Roth. Well, in 2010, was actually passed earlier than that, but it went into effect in 2010. You were able to convert your traditional IRA to a Roth and pay the tax over 2 years. That provision has gone away. But what is still intact is anyone, regardless, you could be making a gazillion dollars a year and you can convert your traditional IRA to a Roth. Now, why is that so important? It's because all of the gain in a Roth is tax-free. You're never going to pay tax on it. You're going to pay tax on contributions going into your Roth. You're going to pay tax on the conversions from a traditional to a Roth, but you're not going to pay tax on any future gain, and there is no limit on the amount of gain in a Roth IRA. So that's why it's so huge. What's another thing that's important about a Roth IRA? Two things. One, you never have to pull money out of a Roth IRA. So when you hit 70 and a half, if you only had a Roth IRA and not a traditional IRA, you don't have to pull any money out of it. Plus, here's what's really cool. A Roth IRA after 70 and a half, or after basically when you retire, whether it's 62, 65, 70 and a half, the Roth IRA is the only IRA that you can make contributions to after you retire. So let's say you retired at age 70 and a half and you decide to work part-time. You cannot fund your traditional IRA, but you could fund your Roth because you plan on living till you're 90. You've got 20 more years of investment growth. That's the beauty of the Roth IRA.
Does it have to be in existence prior to retirement?
No, you could, well, you'd want to set it up before age 70 and a half, yes. Yeah, the answer to the question, safe to answer is yes, yes. Otherwise, you'll have a more difficult time proving income because dividends, rental income, royalties are not considered income. That's part of the problem. So I'm a huge proponent of these Roth IRAs. Here is part of the problem, and I don't want you to think I'm a negative person. I'm a very positive person. I just see lots of issues. 90% of all of us in the entire country have some form of a traditional IRA. And why was that? And why is that? Well, see, well, actually, no, it isn't. But good for you. I love the questions you were. Oh yeah, I was ready to. Oh yeah. Anyway, so be here now. Calm down. So here's part of the issue. We've all been told that we should be opening a traditional IRA, or if you're self-employed, a SEP IRA, to take the tax deductions, to lower our income, so we're not paying as much tax, and that. And because we were going to retire, we would be in a lower tax bracket. And so even though we had a traditional IRA that was tax deferred, we're deferring the tax until we retire, you're all going to be in a lower tax bracket. So when you retire, it's not going to matter. The traditional IRA was the best IRA. Well, guess what? They were all wrong. These tax brackets, don't believe anything I say. I'll just tell you, don't believe anything I say. I make shit up. No, that's not true. I apologize. You better cut that off that. Anyways, these tax brackets are already in place. They're already in place. They're in the IRS tax code. So our tax brackets are already ratcheted up. Then each year, Congress and the IRS, all they do is tweak these. So for any of you who are thinking about taking distributions or other things, these tax brackets are already going up. My game plan is to be in the highest tax bracket when I retire, then I've won. That's my game plan. I know that sounds silly. If you had all your money in a Roth, you'll never get taxed on it. So I would encourage any of you to open a Roth IRA. The rules on the Roth IRA are two. Before you can pull money out of a Roth IRA, the Roth has got to be in place 5 years, and you will have had to hit 59 and a half. So if you're 59 and a half or older and you opened a Roth today, you'd have to wait 5 years before you could pull out any earnings tax-free. If you do conversions or contributions, you can pull that money out. So the Roth IRA is just a really important, I think, tool. And it's a great legacy tool on estate planning where you can put your 8-year-old granddaughter on as the beneficiary, and she would inherit this Roth IRA. Yes?
If you put money in after 70 and a half, how long does that have to stay before you can pull it back out?
Well, if you opened,
Growing in there.
Well, if you opened your Roth IRA at age 69, you're over 59 and a half, but you'll have to wait 5 years in order to pull out earnings without paying the penalty on it. There's a 10% penalty. So so this is what I'm telling people. If you don't have a Roth IRA, don't open a Roth with me. Open a Roth at your credit union or some place where they'll basically do it for free, or $25 a year or whatever it might be, and then just start building up that Roth IRA. And then once you've accumulated money into that, and there's enough money to self-direct, then you would maybe move that account to me. That's how to beat the system, I think. So I don't want to harp too much more on these Roths, but please look into that or check it with your financial planner or CPA about the benefits of doing that, or conversion. For any of you that are self-employed, the majority of you have probably what's called a SEP IRA, S-E-P, a SEP IRA. Most realtors had a SEP IRA, and they were started in 1980. Well, what's replaced the SEP IRA for any individual business owner or any person who's self-employed is what's called the Roth 401k. So anyone who is self-employed, loan officer, realtor, real estate investor, you can open up an individual Roth 401k plan. And your spouse can be a participant in that plan. And you can add money or contributions to the Roth side of the plan. If you're over age 50, it's like $22,000, $23,000. You can add money to the traditional side, and that's about $30,000. So you can fund these Roth 401k plans if you had that kind of money, like $54,000. It's a huge amount of money. And you're building two buckets. You're building the Roth side with tax-free money. You're building the traditional side with tax-deferred money, hedging your bets. So it's something that you might want to look into. We open these accounts for people who are self-employed and want to self-direct their Roth 401k plan. So they're pretty effective for anyone who is self-employed. Any questions on any of that? Or yes, okay.
Can it be some other family member besides the spouse? I don't have one of those.
Okay, well, if they're not legally attached to you, no. Here's, or we open these Roth 401k plans for an individual with a spouse, or with business partners. So that can participate. Yeah, those are the plans. I could set up a Roth 401k plan for a huge company here in Des Moines. I just choose not to, because there's so much additional testing that has to be done. I only focus and allow our company to open these individual, or what they call solo plans, because they're pretty simple. So if you are in business with a business partner, we could open up a Roth 401k plan for you. Or if you're self-employed and your spouse doesn't work, we can still open the plan and the spouse can participate in that. So it's a pretty it's a great feature, and allows the individual who's got disposable income to make contributions to really benefit from that plan. So that's pretty nice. Yes?
If you have funds in a traditional IRA and you want to fund self-directed plan, how do you get around or handle the disqualified individuals when those are really the people you want to deal with?
Okay, the question's...
Like three-way deals with
Sure.
clients or something?
First of all, let me answer part of the first question is, your traditional IRA can transfer into a 401k plan. That's good. Now, to the question you're asking, how do you get around doing business or investing with disqualified persons? It's tough to get around that, or just about impossible. And the good part about self-directing is you can self-direct. The bad part is you can self-direct, and when you are working with private money, there aren't a bunch of rules. When you're working with retirement plan money, there are a bunch of rules. And some of the worst rules for investors such as ourselves is you cannot do business with grandparents, spouses, grandchildren, kids, things like that. Any of the lineal, closely related relatives, you can't do business with. You can't buy, sell, lease, or exchange. It's because the IRS believes that whenever we're working with individuals who are closely related to us, we're doing something under the table or not at fair market value. So that's why they exclude all of the people in that group.
But you can do horizontally, right?
Yes, horizontally you can do business with your cousin, your aunt,
Brothers.
your uncle, siblings, brothers and sisters, you can do business with. And when I found out the rule that Congress and the IRS, when they were designating the disqualified persons, when I found out they inadvertently left out siblings, I thought that was going to be huge. I thought all my clients were going to start working with their brothers and sisters. Well, here's the deal. Not very many of them like their brothers and sisters. Now, so, yeah. So I thought that was going to be a big deal and a boost to people doing business with me, but it's surprising the number of us that don't like doing business with your brother or sister.
My sister moved.
Yeah, yeah, there you go. Yeah, yeah, exactly. And that, yeah, so that's, but it can work. If you can find, my youngest brother, Scott, we're like-minded. And so I partner with him on some investments using my retirement plan. His is locked up in a company, so he doesn't have access to it. So, but it can work. You still need to do things at fair market value. So back to your question, it is difficult, if not impossible, to work with closely related individuals. So,
Do you have a facilitation plan with your different clients that want to do investments then?
do we? No. Here is an issue for us as a self-directed administrator. We cannot marry any of our clients to any of our other clients or any investments because we're a neutral party. We are, you'll get this, we are identical to a 1031 qualified intermediary. Are you familiar with that?
Yeah.
The QI, they sign all the documents, they fund your deal, they give you no advice, they facilitate your transaction. That's exactly what we do with retirement plan money. So whether you make money or lose money, I do not care. Morally I care, but business-wise I do not care. And do you know why I don't care? Because I can't care. When you care or are concerned about your investments, you've established fiduciary capacity. We are not your fiduciary in any shape or form. We're a neutral party that opens your IRA account and funds your investment. That's why I said, here's the good part, you can self-direct. What's the bad part? You can self-direct. Why? Because there's a learning curve on self-direction in retirement plans. And if your CPA, your advisor, your attorney doesn't understand this, doesn't embrace this, you've got a problem. Because we're not there to hold your hand. We're there to guide your hand. Huge difference. And it's just not my company. Any of these self-directed companies, they all tell you all the things they're going to do for you to protect you and make you feel good and make sure your investment goes good. Well, they can't do any of that. They're telling you that to have you open an account with them. No. Here's my attitude. No. You show me that you know what the heck you're doing, that you're a learner, that you're a reader, that you're a rule follower, you know what you're doing. Now I want you as a client because I can't do any of that for you. So I have a different attitude on working with clients than most of these other companies. They collect more people, but then they screw it up down the road. So that's why I do these events, because I want you to learn how to take advantage of your retirement plan, because I am not a stocks, bonds, mutual guy. I don't believe in them. I believe in direct investments that I have control over. I can touch and feel that I can either make a lot of money on my own or screw up on my own. That's me. That's how my client's built. And whether you have $5,000 or $1 million, again, we're not making additional money because we're not assets under management. We make our money by the number of transactions you might do or the number of different accounts. We're transaction based, so there's small fees, transactions. So for our clients that are doing, opening a Roth and making a contribution of $5,000, they want to know, what should I be doing with that? Well, if you've got $5,000, it's somewhat difficult to do self-direction. But you could do buy a tax lien in Iowa. Absolutely, very viable. You cannot lose money on a tax lien. Absolutely, but they're a lot of work, locking them up. You could loan that $5,000 out. You could, if you were really good, you could do an option or wholesale. So one of our clients, I think from Kansas City, is doing, they're doing options. And they opened a Roth IRA with us for $100 because they were going to do an option on a property that was worth, I think, 50, and they thought they could sell it for 60 or 65. This is what I told them. You need to put some more money into your Roth IRA. Here is the problem. You as a private investor can probably do an option for $100. I get that. I've done that myself. But here's the problem. If you do that in a Roth, the IRS believes you need to have what they call substantial investment in order to make that gain tax-free. Here's the problem. They don't define substantial. That's part of the problem with the IRS tax code. So I told them it'd probably be smarter for you to put in $500 or maybe $1,000 into your Roth account and then do the option for $500 or $1,000. That's more substantial than $100. But don't believe me, please ask your CPA. So,
Do you run into usury issues when let's say we were doing a deal and she was self-directing a project for me?
yes.
And I was paying her 30%. Is she gonna run into usury issues on that?
Yeah, let me answer your question. Let me just
Sure.
just continue where my track was going with this. So, the client wants to open the account with us. He's going to do these options because he understands how to do these privately and now wants to do them in his Roth IRA because we've been talking about this and I've been sending him information on this. And so he's ready to rock and roll. And then I tell him, you probably, don't believe me, I'm not supposed to give you any advice, but you probably should fund your Roth with a little more money and make a little more substantial down payment on that option than $100. But don't believe me, ask your CPA. So I, in my mind, are covering his tail, even though I'm not supposed to, because he doesn't know where to turn to. I told him, ask your CPA. So he does. Now here is the problem, and the CPA goes, I don't know. I don't understand these self-directed IRAs. I'm not sure who Nexus Direct IRA is. I don't know what this gentleman's telling you to do. And so now I've got a delay of 2 weeks or longer while he and his CPA are trying to figure this out. That's part of the problem. That's the delay that happens, which irritates me because I'm not supposed to be able to help you. If I don't help you, you won't get past go. So then I have a conversation and then the CPA and I talk about it and then I say, well, he could fund the deal with $100. I think that's a red flag. I think you should put some more money into that. I said, it's not really covered in the tax code. It's just from information I've been given on the training that I've had. And then the CPA goes, you know what? I think you're absolutely right. I'm going to make him do $1,000. Now we're getting on the same page because now the CPA is engaged in this process and a little worried about his client. That's good. Yeah, anyways, back to your thing. Yes, there's usury limits on these interest rates that can be charged, and every state is different. And I will tell you that most private lenders who are lending money are breaking the usury limits all day long. Because one, they don't understand them. Number two, the commerce departments for these different states have a hard time focusing on that. For instance, in the state of Minnesota, when I've done these seminars and I ask all the investors who are familiar with usury, less than half the hands go up. I ask those who are familiar with usury, what is the usury limit in Minnesota? And they all say it's 8%. Well, guess what? It isn't 8%. It changes on a monthly basis. All these states, the usury limit changes. And you can go to your state and find out what the usury limit on. So in, I don't know what it was in November because I didn't check, but in October it was 7.2 in the state of Minnesota. But see, the investors from Minnesota, who are smart people engaged, they hear at one point it was 8% and they think the usury limit is always 8%. No, it's not. It changes. So you have to be careful on that. And there are different states that have higher limits on usury. So if you are going to be a hard money lender, And these usury limits pertain to private money and IRA money, if you are basically considered an active lender. So if you're going to be a lender out of your retirement plan, and I like that when clients do that, I think it's a no-brainer. Even though I believe in real estate gets messy, and in a self-directed IRA, you've got to have a chunk of money. Plus, you can't do any of the rehab work yourself. When you buy a piece of real estate in your retirement plan, you cannot participate in that investment and make any improvements to that investment at all. All of it has to be done by contractors that are paid by IRA money.
So you're saying you physically cannot pick up a hammer, but you can hire a crew that comes from the IRA money. You cannot commingle your personal funds as well as IRA money.
Exactly. So that's part of an issue with your retirement plan. So you can go, as the owner of your IRA and the owner of the real estate that's owned by your IRA, you can go to Home Depot with your designated roofer and say, Mr. Roofer, these are the shingles that I want put on my IRA investment. Then the roofer pays for those. The roofer puts those on, and that bill is paid by out of your IRA account. You can't pound the nails. So as the IRA owner, you can oversee your IRA investment. You just cannot provide any services. I will tell you, it's a dumbass rule. That's part of the problem with this IRA stuff. I'm an active investor. I like things done my way on my time, the way I want it. Otherwise, I'm irritated. And so in these retirement plans, there's a set of rules, and I've got to follow and be inside these rules. So you just understand the rules, and then you figure out how to legally work within the rules. So, and it can be done. It even works for somebody like me, who's kind of a renegade. It does, I'll just tell you. I do not buy any more properties right now with private money. Everything I'm doing is in my retirement account. Why would I want to have anything in my private? No, I've owned investment property. I've already maxed out all the depreciation and interest I possibly can take. Owning another piece of property with private money does nothing for me. That's why I use my retirement plan. That's all I care about now is building my retirement plan. That makes the most sense. Now, back to your thing. So if you're going to do hard money lending, which I think is really cool, because you can barely screw it up, especially if you secure it to everything that you possibly can, it's not as messy as real estate. So find the state, and there are states out there that have high usury limits. There's also, depending on the state, a couple different ways of getting, of legally working within that usury limits. For instance, let me use the state of Minnesota. In the state of Minnesota, to avoid usury limits or breaking that rule, the loan has to be what they designate a commercial loan. That's $100,000 or more. That's one option. Number two, if the loan is business to business, you can also circumvent usury limit. What does that mean? So, if you're going to do hard money lending, you'd open an IRA account with us, you'd set up an LLC, limited liability company, we would fund your IRA money into the LLC, you're going to loan money to a rehabber, they need to set up an entity, and now you're going to loan your 100 grand to them at 22%. Entity to entity, business to business. You see that?
So as the owner of the LLC, the money comes into my LLC, or is the IRA connected to the LLC?
We fund your IRA
Right?
into the LLC, and your IRA owns the LLC.
Sure.
You're the owner of the IRA.
Okay.
Now, what's the beauty of the LLC? And I'd love to talk to you about these LLCs because they're fascinating and they're fantastic for asset protection and anonymity. And you've sidetracked me. So if you're going to do the hard money lending, you'll really want to find which state and then set up these entity structures because you'll have a lot more freedom. But we like it when our clients set up these entity structures because then you can fund investments quicker on your own. You have total control of the IRA money that's in your LLC. The investment, why do we like that? It's because we've taken your IRA, funded it into the LLC, and then the investment is done as far as we're concerned. We funded your investment. The investment, as far as we're concerned, is the funding of your LLC, and we charge you $150 to fund that. And now your LLC's got, I'm going to make it up, 200 grand in it. And you buy an investment property for 100,000, and you're going to rehab have a contractor rehab it, and you've got additional money in there. And then you have set up your LLC at your favorite bank here, and you've got some designated money in the LLC, and you're putting it in 3-month or 6-month certificates of deposit to make some additional money. And then you're going to loan out $50,000 out of that LLC, hard money, to somebody else. That's the beauty of this structure. Now, how do people screw that up? Which is just irritating to me, and I can't do anything about it. Their last name is Anderson, or something, you know, they name their LLC after their name. Drives me nuts. What have you done? You've breached the anonymity of the LLC, and you've done that out of ego and stupidity. And your attorney didn't catch you. I want to choke all of you. It's not my right. Or you're telling everybody, well, I have an LLC that's owned by my IRA. No. The only people that are supposed to know that your LLC is owned by your IRA is you, me, and your attorney and CPA. End of story. Otherwise, again, you've breached the anonymity of your LLC. You don't want anybody to know what you're doing. At least that's where I come from. Oh, anyways, whew, okay. So, these concepts are fairly simple, it's just that they get somewhat complicated inside. So, how do we help you and stay within the rules? So, in order to set up an LLC that's going to allow an IRA to be owned, or to allow the LLC to be owned by the IRA, there's some language that has to be incorporated into the LLC documents. Not rocket science. We email that to you. Here's the thing. We don't want you to screw up. So we try to cover your back as legally as we possibly can. So we send you the language. We also send you a sample generic filled out LLC document and email that to you, your attorney or your CPA, so they can all look at that as a sample to help on your learning curve and their learning curve, because we want you to set it up correctly. That's what we try to do for any people that work with us. Again, it's not advice. We label it education. That's what we do. And then, within that LLC, you're ready to rock and roll and do multiple investments in it. And the other thing is, because we're transaction-based, every time you fund something, we charge you a fee. If we funded your LLC, you get charged once. You can do multiple transactions in that LLC and avoid our fees. Isn't that good? Yes, that's good. Now, why would I tell you? Because that's what I do. I'd want you to know the same thing. So,
Can that LLC have employees?
it could. It's best if you don't mix that with your IRA. It's really best if you don't do that, I think. I think it's also best if you have multiple LLCs for different investments. Sure. The reason people don't do that is, one, it's a pain, it's cumbersome, and it gets expensive. It should be done that way. They just don't do it that way, and I get it. You know, I have so many checkbooks for LLCs, can't keep track of them. That's part of the problem. So luckily I have a bookkeeper or a CPA that do. So, if set up properly, this works really well. For our younger clients who maybe have $10,000 or $20,000, what we try to do is get them to find somebody who's like-minded by coming to one of these events. I think these RIA events are fantastic for people to do their haves and wants and figure out who they could potentially partner with. Because a lot of people have a 401k plan that's locked up, or it's in a union plan or a government plan and they can't get access to it, but then they maybe have a small independent IRA for 25 grand. And they can't get to where they want to go, so they need to find somebody that is like-minded that they could partner with, and you could do that. You could find 4 people with $25,000, set up an LLC, and now you've got 100 grand in that. And then you go to a local bank and get what's called a non-recourse loan that you can fund to IRA investments for, let's say, $100,000. Now you've got $200,000 inside the LLC. Now you've got some horsepower to do some investments.
Did you just say you could set up multiple IRAs from different beneficiaries that own the same LLC?
Okay, the question you asked, did I say you can set up multiple LLCs owned by different beneficiaries?
One LLC
Oh,
owned by multiple beneficiaries.
Yeah,
Percentage
that can be, okay. I didn't say that, but now that you've asked, I will say that.
Okay,
And you're not even a plant.
right.
No.
Yeah.
So, and guess what? You're helping me because I don't have a PowerPoint and you're keeping me on kind of track. So, what is the legal workaround? You want to partner with your spouse because, and I'll tell you, she's got more money in a retirement plan than you do. She's got 100 grand, you've got 50. There's not enough for you to do anything with your 50. You want access to her 100. So, here is the workaround. If you're disqualified persons, if you simultaneously fund a brand new investment, it's called a partnered transaction. It's really cool. So, what would you do? You'd set up an IRA with us, she would set up an IRA account with us, you set up a brand new LLC, her LLC, her IRA, because she's got funding it with 100 grand, is going to own that, I'm going to make, so I can do the math, 3/4, and your $50,000 IRA is going to own it, the LLC 1/4. And now you've done a partner transaction with a disqualified person. And now you've got $150,000 funded into that LLC that's owned by 2 IRA accounts. And we fund that the same day, simultaneously. Here's what you can't do. You couldn't set up an LLC, fund it with $50,000 of your own money, and then after the fact, bring in your spouse for $100,000. So it's the process, it's the timing of how to correctly do this. So again, we try to, under the education, instruct you on how to try to do this. I send any of you, whatever you want, as much educational material on this as possible. But you got to be a reader and a thinker in order to do this. And then we kind of answer your questions. Let me go to yours because I'm out of time.
5 minutes.
Because, yeah, we're almost out of time, yes.
So if my daughter and I set up an LLC, and I have the self-directed IRA, and I put the money in that LLC,
Yes.
then we can do business together in that LLC.
Yes, here's what you could do. It's also called a partner transaction. You've got IRA money. Your daughter does not. You fund the LLC with your IRA. She puts in her 20 grand of private cash. So it's a partner transaction. Your IRA is an owner. She's an owner privately.
So what if she has no cash?
Well, then how can she have any ownership interest in an entity structure with no money?
Well, but she could, maybe, let's say she puts in 500.
Well, again, if I was the IRS agent, I said, how is that substantial?
Gotcha. What if we already had the LLC set up? It was already set up?
Can't do it.
Okay.
You can never fund your IRA into an entity or investment that you currently have ownership interest in. So that creates and forces you to set up a brand new entity. And because I will guarantee you that the LLC that you've got set up now is not compliant with accepting IRA funds anyways. I will, yeah, I'll bet you my truck. It's a pretty nice truck. It's a hybrid.
Need a truck.
No, okay. No, I was going to the Romney $10,000 bet. I thought that's what went through my mind right now. That was pretty cute, wasn't it? No, I'm sorry. We're past all that stuff. No, so, oh, that was really, I woke you up, didn't I? All right, so, but.
Don't run for president, though.
No, I'm not going to run for president. Okay.
Get you in trouble.
I know I'll get into trouble. Yes.
One last question. How do you use these to deal with the potential increase in the inheritance tax?
Yeah.
Going up from $1 million to $5 million, and you're sitting here with a bunch of real estate.
Yes.
And,
Well, here's the beauty of these retirement plans. If you have assets inside your retirement plan, they go to your beneficiary tax-free, especially if it's in a Roth. If it's a traditional IRA, it flows to your beneficiary, and then they've got to take some required minimum distributions each year. There's a table for that. So there is some asset and estate planning techniques. It's really fantastic with a Roth. So quickly, one of our clients, 77 years old, was looking at converting $660,000 in his SEP. He was all over it. I said, good for you. I think that's a smart move too. I said, don't believe me, don't trust me, ask your CPA. And I said, but the problem is it's going to be the kiss of death. I said, I'll be interested in getting the answer. And it's only because CPAs are so tax adverse, and they want to make sure they got you covered. That's why. So he called me back 3 days later and said, my CPA told me not to do the conversion. I said, why did he tell you that? I said, is it because the amount of tax you're going to pay on that $660,000? He said, no. He was concerned about that, but his bigger issue was, I'm 77 years old, and my CPA said, what if you die? You have to pay the tax. I said, no, your CPA is wrong. What if you die? And you were smart enough to put your 8-year-old granddaughter on as the beneficiary of that Roth. She just inherited that Roth tax-free. It doesn't get any better than that. I said, plus, you told me your life expectancy was 90 to 92. I said, if you have done anything and understand these investments, you'll have made up the tax in 3 to 5 years, and then everything else is tax-free. So don't be afraid of paying tax. Just understand what tax you have to pay. So here's the takeaways. Please look into these Roth IRAs. Please look into this 3.8% tax on these investments after the first. Please look into these Roth 401k plans if you're self-employed. Please check out crowdfunding. Please go to our website. If you want the PowerPoint, email us. We'll be happy to get it to you because honestly, we do want to help you. My staff is marvelous to work with, and guess what? You don't have to work with me, you get to work with them. And we've got a booth here and happy to answer any questions. So, yes?
Thank you. Did you?
Quick question, okay, go ahead, Rich.
Oh, if you were going to convert your traditional IRA to a Roth and you expected personal income tax to be going up, now would be a good time to do it.
Okay, quickly, here's my answer to that. If you do a conversion of your Roth today, now in November, when do you have to pay the tax? December, January, February, March, by April 15th. So you've got just about 4 to 5 months to pay the tax. If you have that amount of money to pay the tax and your tax bracket's going to go up substantially in 2013, yes, I'd do the conversion. If your tax bracket's going to be pretty much the same, do the conversion in January. Why? Because then you have 18 months before you pay the tax.
Yeah.
Okay?
We are going to have to
Okay,
cut this
got it.
off.
Good, thanks.
Thank you for coming.
I'll be sticking around.
We're going to take